the Recovery Loan Scheme. In this video I want to look at the recently announced Recovery Loan Scheme and how it varies from the bounce back loans that I know an awful lot of people have got and the CBILS, Coronavirus Business Interruption Loans, got it, and see how they vary to those loans that we're sort of being used to. Now the bounce back loan and the CBILS loans end at the end of March, and then the recovery loans start from the 6th of April. Let's have a look at them and what the differences are and why you might want to like one of the new loans, or actually why you need to quickly act and get one of the old loans. I'll be covering all sorts of tax and finance issues in my videos, so if you'd like to subscribe you can be kept up to date. If you press the like button it really helps me get the message across, and I'd be interested to see your views in the comment section. So let's dive into the Recovery Loan Scheme. So it is different to bounce back loans and to CBILS loans, although it has some similarities. It's sort of like a mezzanine layer between normal commercial loans and the very generous terms that were done in the outgoing loans. So what are the differences? Why would you want one of these new loans? So what would motivate you to have one? So the first thing that's different is that the type of loan is much broader. So with a recovery loan it can include an overdraft or asset finance or invoice finance, factoring, or just a normal loan indeed. Whereas the old bounce back loans and CBILS loans were simply just loans. So it gives you much more flexibility in the width of product that you might like. So that's an important reason why you might want one of these loans. And I think the other reason why you might want one is because there is no turnover cap. So with a bounce back loan and a CBILS loans, you are capped at 25% of your turnover back in normal times. And that was a restriction, particularly if you had a low figure or you're growing fast and you needed more money than 25% of your turnover. So if that was a problem, then you might want one of these new recovery loans to breach the gap between maybe you've got a bounce back loan and what you actually need. So I can see that people with turnover were restricted by turnover. I can see them really looking forward to being able to activate these new loans. So what are the main terms of the new loans? Well, for a loan it's up to 6 years, very similar to a bounce back loan or a CBILS loan, so up to 6 years. And if it's for the shorter term finance, it's up to 3 years, so for an overdraft for 3 years. And the bit that the government's giving you is that there will be no personal guarantee on loans less than $250,000. And to be honest, once a loan gets over $250,000, what's the point of a personal guarantee? Because most people don't have $250,000, and the bank won't be able to secure it on your main house. So that means that I know that personal guarantees are a big issue for small business because we hate giving personal guarantees because it means that we become personally liable for the debts of the business, and it just makes us feel uncomfortable. So it takes that away, and the way it works is that the government is taking 80% of the risk on the loan and the bank itself is taking 20% of the risk. That means that the banks won't be cavalier in the way that they give the loans. So for example, bounce back loans, they came back within a day and some basic checks were done, but there was no obligation to prove cash flow forecasts, for example. So with these loans, the banks will be looking to lend them on commercial basis, a normal commercial basis. So therefore, you will need to show affordability. Now another giveaway, if you like, is that they won't reference the bad year. So if you had normal trading up until 2019, you then had a virus infected year and you had whatever, they won't include that year in the forecast. So they'll look at your trading up until 2019, and then they'll look at your forecast to make sure that you are expecting to be able to pay it off. The other reason that you might want one of these loans is that you can sort of stack them. So with the CBILS and bounce back loans, if you've got a CBILS loan, which is bigger than a bounce back loan, the first part of the CBILS loans paid off the bounce back loan. So if you had a £50,000 bounce back loan and you wanted another 200,000, you actually had to get a CBILS loan for £250,000. You paid off the bounce back loan, and then you got 200,000 and the bounce back loan was paid off. That's not the case with the recovery loans. So you'll have maybe your bounce back loan or your CBILS loan, and then on top of that you'll be able to put one of these loans. But of course, that said, you still need to be able to prove affordability of the whole loan package. So if you can only afford a £250,000 loan, you can't get a £250,000 CBILS loan and then also a £250,000 recovery loan. But I think all small businesses would understand that is not a reasonable thing to do. So what do these loans cost, and who pays for that? Well, this is a difference between the CBILS loans and these new loans, in that you will be expected to pay for the cost of setup costs, unlike a CBILS loan where that is taken by the government. And the interest rate, from the literature I've read, the interest rate will not be set by the government, so you'll be at commercial interest rates. That said, interest rates generally are pretty low, and I don't know whether they'll be capped at a certain level. And I would certainly expect the government to be monitoring the interest rates and make sure that they're reasonable and not usurious. But the 2.5% that we're paying on CBILS and bounce back loans, it may be a higher and it may be a variable rate. So you're going to have, in all probability, higher costs to borrow. So this is where it's a sort of mezzanine layer between a normal commercial loan, so you perhaps pay normal commercial rates, but you're not taking the personal guarantees that you would normally do on a small business loan. And that's where it fits into the whole scheme of things. The last feature is how much can you borrow. So for a loan, you can borrow £25,001 to 10 million, which is plenty, isn't it? And that personal guarantee, no personal guarantee up until £250,000, but you can get smaller amounts for the short-term loans, like £1,000 for an overdraft facility. So there should be, that's plenty big enough for small businesses. That when we were doing the CBILS loans, I know that the difficulty was in proving that you could pay it back and that you needed the money, so getting that balance right. And I think the banks will be looking for those same two criteria. They'll want to know that you do need the money, and they'll want to know that you can pay it back, not completely unreasonably. So there we are, recovery loans. I think they're an interesting addition into the pot. They're available from the 6th of April for 6 months, as the CBILS and bounce back loans leave us. All we have to do with them is pay them back. The terms, I think, the personal guarantee is a big deal. Having access to the banks, and hopefully the banks will be reasonable about lending the money, particularly since they're taking only a small segment of the risk. And I'd expect actually them to be not that popular, because I think almost every business has got a bounce back loan. Every business that needs it has got CBILS loan, and if you've got those, then the number of people who need the additional amount for these recovery loans maybe is not the biggest pool in the world, but I think they will be important as well, because even if it's only 1 in 100 businesses, that's still an important number of businesses. So thank you for watching. If you would like to subscribe, I'll be giving you more updates, normally every week. If you'd like to like the videos, that helps me get the message across. And I'm always interested to look at your comments, and I will answer them within a reasonable period if you've got a question. Thank you for watching.